Ever get that weird feeling like something big is about to happen, but you can't quite figure out what it is? The markets are going crazy, prices are going up, and everyone's talking about inflation. Well, Warren Buffett has noticed something too, and it's not good news. While everyone's focused on the US and Europe, Buffett is quietly watching Japan. Could Japan's economy trigger the next market crash? Let's find out. Welcome back to the channel. I'm your go-to guide for making sense of the madness in the financial world. And today, we're diving into why Warren Buffett is paying close attention to Japan and how it might spark a global market meltdown. Stick with me as we unpack Buffett's latest moves, Japan's economic warning signs, and most importantly, what you can do to protect your investments before it's too late. Warren Buffett has been using something called the Buffett indicator for years to gauge whether the stock market is overpriced. It might sound complicated, but it's actually pretty straightforward. Here's how it works. You take the total value of all publicly traded stocks in a country, let's say the US stock market, and divide it by the country's gross domestic product, GDP, which is basically the total value of everything the economy produces. When this ratio gets too high, it means that stock prices have grown much faster than the economy itself. Think of it like inflating a balloon. You can keep blowing it up, but eventually it's going to pop. The Buffett indicator serves as a warning that the market might be in bubble territory, where stock prices are artificially inflated and not backed by real economic growth. Historically, a Buffett indicator above 120% has been a red flag. It means the stock market is worth significantly more than the actual economy, and that's when you start to see trouble on the horizon. For example, before the 2000 dot-com bubble burst, the Buffett indicator hit 137%. And just before the 2008 financial crisis, it was around 105%. But here's the scary part right now. We're not just a little above that danger zone. We're way past it. Back in 2019, the Buffett indicator hit 145%, which was already sounding the alarm. By 2022, that number skyrocketed to a record-breaking 197%. And as of 2024, we're now sitting above 200%. To put that into perspective, the US stock market is currently valued at more than double the size of the entire economy. That's bubble territory, and it's worse than what we saw before the 2000 and 2008 crashes. So, if history is any guide, we could be on the brink of a major market correction. Now, what does Warren Buffett do when he sees these kinds of numbers? Well, unlike most investors, he doesn't panic, and he definitely doesn't chase after rising stocks. Instead, he's been preparing. Buffett has been quietly building up his cash reserves, basically sitting on the sidelines and waiting for the bubble to burst. He knows that when everyone else is panicking and selling, that's the time to swoop in and buy up assets at bargain prices. This strategy has made Buffett one of the wealthiest and most successful investors in history. While most investors are caught up in the hype of rising stock prices, Buffett has been quietly building up his cash reserves. Right now, nearly half of Berkshire Hathaway's portfolio is cash. Why? He knows that when the bubble bursts, cash is going to be the most powerful tool to scoop up undervalued stocks at bargain prices. When everyone's panicking, Buffett's waiting to pounce. He's built his entire career on doing the exact opposite of what the crowd does. So when he's holding back like this, it's time to pay attention. Now, here's where it gets interesting. Buffett's not just watching the US market. He's looking at Japan, and he's not alone. Japan's economy, with its deflation issues, ultra-low interest rates, and skyrocketing debt, has been quietly becoming a massive threat to the global financial system. Japan has been borrowing heavily for decades, trying to stimulate its economy and fight off deflation. But now, Japan's national debt has ballooned to over 260% of its GDP, the highest debt level of any developed country. To put it in perspective, that means Japan owes more than twice what its entire economy produces in a year. This kind of debt creates a fragile situation, especially with rising inflation creeping into the picture. If Japan's central bank is forced to raise interest rates to combat inflation, it could have a ripple effect on global markets. Higher rates would make it more expensive for the Japanese government to service its debt, but it also spells trouble for global investors, particularly those involved in what's known as the carry trade. In this strategy, investors borrow money at Japan's ultra-low rates and invest in higher-yielding U.S. assets like stocks and bonds. But if Japan raises rates, these investors would have to pay back their loans at much higher costs, which could lead to a massive sell-off of U.S. assets as they scramble to cover their losses. This is one of the key reasons Warren Buffett is being cautious. He sees the potential domino effect a shift in Japan's policy could trigger a financial shock in the U.S. market, and he's preparing for the fallout. By holding back and building up cash reserves, Buffett is positioning himself to take advantage when the markets inevitably correct. What do you think? Could Japan really be the trigger for a global market crash? And how are you preparing for a potential downturn? Let me know your thoughts in the comments. I'm curious to hear what your strategy is. If you're finding this video helpful, hit that like button and share this video with anyone who needs to hear about these risks. Remember, preparation is key. Don't panic, but don't ignore the warning signs either. Diversify your investments, keep some cash on hand, and be ready to take advantage when the market pulls back. If you want to learn more about how Warren Buffett turns market crashes into profit opportunities, make sure to subscribe and click on the video on your screen to see how he does it.